Hey everyone, welcome back. Ready to dig into another deep dive. Today we're tackling a real Wall Street classic, Benjamin Graham's The Intelligent Investor.
It's a big one.
It really is. It can feel, I'll be honest, a little intimidating. It's like, whoa, this is the heart of value investing. Can I even understand this? But that's why you're here. You always find a way to bring these ideas to life.
Well, Graham was all about making investing accessible to everyone, not just the Wall Street gurus.
Exactly. And he had a way of cutting through the jargon and getting to the core principles, right?
Absolutely, and those principles are just as relevant today as they were when he first wrote the book. Maybe even more so.
So you're saying even if we're not aspiring hedge fund managers, there's something in here for us regular investors.
Absolutely. In fact, I'd argue that some of Graham's most important insights are the ones that challenge the way we think about the market altogether.
Like what? Give us an example.
Well, take his definition of an intelligent investor.
Mm-hmm.
You might think it's all about having some genius-level IQ or cracking secret formulas.
Right. You need to be like some kind of math whiz to understand the market.
That's what most people think.
Yeah.
But Graham completely flips the script on that. He says intelligent investing is way more about managing your emotions than outsmarting everybody else.
Whoa, really? So it's like a mental game more than anything.
It's about having the discipline, having that patience, and thinking for the long term. Those are the qualities that really matter.
It's funny. That sounds more like something you'd hear from a therapist than a Wall Street titan. Did Graham always have this like Zen approach to investing? Or did he learn that the hard way?
Oh, he definitely learned from experience, and not always the good kind. Early in his career, Graham rode the market roller coaster, just like everyone else. Huge wins, followed by, well,
Ouch. Yeah, those market crashes can be brutal.
Exactly. And those early booms and busts really shaped his philosophy. He realized that trying to time the market or chasing after the latest hot stock, that was a recipe for disaster.
So how do you avoid getting caught up in that frenzy? It's hard. Everybody's always trying to tell you about the next big thing.
It really is. You have to remember that the market isn't always rational. In fact, it can be downright emotional.
It's true. It's like it has a mind of its own sometimes.
And that's where Graham's famous analogy of Mr. Market comes in. Imagine you've got this, well, let's just say, an interesting character who shows up at your door every single day.
Okay, I'm intrigued. What's Mr. Market want?
He's eager to buy or sell you shares of businesses. But here's the catch. His offers are based entirely on his mood that day, which, let's be honest, changes all the time.
So Mr. Market represents that irrational side of the market, right? All the ups and downs that have nothing to do with how companies are actually doing.
Exactly. Mr. Market, he's driven by fear and greed, rumors, speculation, you name it. And Graham's advice, don't let this guy dictate your investment decisions.
Easier said than done, though, right? It's tough to stay rational when everyone's either euphoric or panicking.
It takes discipline, for sure. But Graham gives us a really powerful tool to cut through all that noise and make good decisions, focusing on what he calls intrinsic value.
Intrinsic value. So we're not just talking about the stock price.
Right. It's about looking beyond those daily market fluctuations and figuring out what a business is truly worth based on its assets, its earnings power, its long-term prospects, all the things that actually make a company valuable.
So instead of trying to guess Mr. Market's mood swings, you're looking at the bigger picture. Kind of like, I don't know, judging a house by its foundation and structure, not just a fresh coat of paint.
Exactly. And speaking of looking at the bigger picture, Graham's approach to inflation always intrigued me. You'd think with all the worries about rising prices, he'd be all in on stocks. But it's not that simple.
Really? So what did he recommend?
He was a big believer in balance, having both stocks and bonds in your portfolio.
Now that's interesting. With inflation eating away at returns on bonds, isn't that counterintuitive?
See, Graham was a real student of the market, a bit of a history buff, actually. He dug into past periods of inflation and found that while stocks do offer some protection, their earnings don't always rise perfectly in sync with inflation. Bonds, on the other hand, yeah, they can be vulnerable to inflation, but they offer stability, a steady stream of income.
So it's about finding that balance, that sweet spot between growth and managing your risk. And that's where Graham's analytical mind really shined through. He's giving investors the tools to figure out what something is really worth, whether it's a stock or a bond, no matter what's going on in the market as a whole.
Exactly. And it gives you a framework for thinking about risk that applies to any investment.
So let's talk about those high-growth companies, the ones that everyone's always chasing after. I feel like Graham was a little wary of those, wasn't he?
He called them growth stocks, and he argued that their very popularity often made them a lot riskier than people realized.
Really?
Yeah.
Because everyone wants a piece of the next big thing.
And that's the problem. Graham always said, the investor's chief problem and even his worst enemy is likely to be himself. He knew how easily emotions could lead to costly mistakes, especially when it came to those exciting growth stories.
It's true, it's easy to get caught up in the hype. So what did he recommend instead? How did he say we should navigate this like treacherous terrain of investing?
He was a big advocate for what he called bargain issues or undervalued companies. He said it's like searching for hidden treasures. You're looking for those solid businesses that, for whatever reason, the market is overlooking or undervaluing at the moment.
I love that analogy. So he wasn't afraid to be a contrarian, to go against the crowd if he believed in the underlying value.
Exactly. And that took a certain kind of temperament. He had to have the patience and the conviction to stick with his picks, even when the market didn't agree with him right away.
He sounds like such a fascinating figure. It's clear that Graham wasn't just interested in, crunching numbers. He understood the human element of investing, that psychology plays such a huge role.
Absolutely. And he had this incredible ability to combine that understanding with a really rigorous approach to analyzing businesses.
Mm.
And that's what made him such a powerful force on Wall Street. That's exactly it. He saw investing as a form of, intelligent entrepreneurship.
Yeah.
He wasn't just buying pieces of paper. He was buying ownership in real businesses with an eye toward the long term.
Makes sense. But finding those bargains, that can't be easy. It's not like everyone's just giving away pieces of profitable company.
You're right. It takes work. Graham believed that one of the best places to find those opportunities was among companies that had been overlooked or undervalued by the market, often because of temporary factors or just, negative sentiment.
So he wasn't afraid to go against the grain, to be a contrarian if he believed in the underlying value. He had that rare combination of patience and conviction.
And that leads us to another really crucial part of Graham's philosophy, and that's the distinction between speculation and investment. He truly believed that speculation, trying to predict those short-term market movements, was, well, kind of a fool's errand.
It's like trying to predict the weather. You might get lucky sometimes, but
Exactly. You're going to get caught in the rain eventually. Graham believed that true investing was about focusing on those long-term fundamentals of a business, not those day-to-day ups and downs of the market.
so less gambling, more like being a business owner.
Exactly. He was playing the long game, focusing on the underlying factors that drive long-term value.
And that takes discipline to tune out all that noise.
For sure. But Graham, he also stressed the importance of not, putting all your eggs in one basket. He was a big fan of diversification, spreading your investments across different assets to lower your risk.
That makes sense. Even if you're a master stock picker, you can't predict everything.
Right. Diversification helps cushion those unexpected blows a little bit. He even suggested a specific strategy, a portfolio of, roughly, 50% stocks and 50% bonds.
That 50-50 split, it might sound a bit simple, especially in today's world of fancy investment strategies, but it really highlights Graham's emphasis on balance, on managing your risk.
It's a good place to start, especially for new investors. Of course, everyone's situation is different, and you have to think about your own risk tolerance. Speaking of different approaches, Graham also had some interesting thoughts on investment funds, particularly what are called closed-end funds. Have you heard of those?
Closed-end funds, they're a little different from the usual mutual funds and ETFs, right?
Exactly. They're a little more under the radar. With open-ended funds, like mutual funds, new shares are created and redeemed based on investor demand. But closed-end funds, they have a fixed number of shares, and those shares are traded on an exchange just like stocks.
Okay, so the supply is limited, which means the price could swing up and down more dramatically.
Exactly. And here's where it gets kind of cool. Graham noticed that these funds would often trade at a discount to their net asset value, or NAV. Let me give you an example. Say a closed-end fund owns a basket of stocks that are worth, let's say, $10 per share. But because of how the market works, the fund itself might be trading on the exchange for only $9 per share. So there's a discount.
Ah, so you could potentially snag a bunch of assets for less than their real worth. That almost sounds like those bargain issues we were talking about.
Right. It can be. But just like with any investment, you have to really understand the risks. Closed-end funds can be less liquid than open-ended funds. It might be harder to buy or sell them quickly. And those discounts, well, they can widen or narrow over time.
So it's not a sure bet by any means, but it's definitely an area where Graham saw an opportunity for those who are willing to do their homework. He was always on the lookout for those market inefficiencies, those little quirks that he could, use to his advantage.
He was all about doing your research, making sure you really understood what you were buying. That was a core part of his whole philosophy, really. He believed that knowledge was power when it came to investing.
He wanted to give everyday investors the tools to succeed, didn't he?
He absolutely did. He wanted people to take control of their financial futures, to make informed decisions, and not just rely on, so-called experts.
That's empowering. It's not just about blindly following formulas, it's about thinking for yourself, doing your research, making decisions that align with your own financial goals.
That's exactly it. And that focus on individual empowerment is why Graham was so skeptical of, well, financial advisors and analysts.
He had some strong words for Wall Street, didn't he?
He did. He acknowledged that there are many skilled and ethical people working in finance, but he also warned investors about conflicts of interest and the dangers of blindly taking advice.
It's your money on the line at the end of the day, right? Not theirs.
Exactly. And he had some really pointed questions he encouraged investors to ask potential advisors. Questions like, have you ever had a formal complaint filed against you? Or, why did your last client fire you?
He wasn't messing around. He really wanted people to be savvy about who they trusted with their money. But it all comes back to that idea of empowering the investor, right? Encouraging people to be discerning, not just hand over control of their financial well-being to somebody else.
Absolutely. He also said it's important to make sure your investment philosophy aligns with that of your advisor. If you're a long-term, value-oriented investor, you probably don't want an advisor who's pushing you to chase the latest hot stocks or take huge risks.
It's like finding a doctor who understands your needs and shares your approach to health. You need to be on the same page, working toward the same goals.
Exactly. It should feel like a partnership, and it's so important to find someone who's a good fit for you and how you want to invest. Now, speaking of different investing styles, I think it's really interesting how Graham challenged some of the traditional thinking, even when it came to successful companies.
You're talking about his idea that sometimes the more successful a company is, the more speculative its stock might become. It does seem kind of counterintuitive, right?
It really does, right? You'd think a company with a great track record and amazing prospects, that'd be a sure thing. But Graham saw that the market, well, it often gets carried away. It gets overly enthusiastic about these high-flying companies, and it can push those prices up to unsustainable levels.
He was wary of those companies that everyone loved, where the excitement maybe outweighed the actual fundamentals of the business.
For sure. He argued that the higher the price you pay for a stock, the less room you have for error. Right. And the more dependent you are on the market continuing to be excited about that company.
And that excitement doesn't always last.
Unfortunately not. He actually used international business machines, IBM, as an example. Even though IBM was and is a phenomenal business with a long history of success, its stock price had some wild swings over the years.
Driven more by how people were feeling about the company than how it was actually performing.
Exactly. And that's what Graham was always trying to teach investors to see past. He was wary of what he called the speculative factor in stock prices, that tendency for the market to get ahead of itself, to bake in all this future growth that may or may not actually happen.
Like those dot-com stocks back in the day. Lots of hype, not always a lot of substance.
Exactly. And even if there is substance, the price might already reflect those future gains, leaving little room for investors who buy in later.
So he's saying, don't just look at how well a company is doing. Look at what you're paying for that success. Make sure the price is right.
Precisely. He always reminded people, price is what you pay, value is what you get.
It really is. It's a good reminder that even with those big-name companies, you can still overpay, and that price and value, they're not always the same thing. Which brings us back to that idea of margin of safety. If you can buy something for less than it's really worth, you've got a bit of a cushion to protect you from, well, the market doing its thing and all those curveballs that nobody sees coming.
Exactly. And it leads us to another key takeaway from Graham. Those undervalued assets we were talking about. Well, they can stay undervalued for a long time.
Right. So you're saying it's not just about finding those hidden gems. You also need the patience to wait for the market to catch up.
Exactly. It's a waiting game sometimes. Not about getting rich quick, that's for sure. Graham was all about the long game. Investing is more like a marathon, not a sprint. And this is where we come back to his central message. It's not just about crunching numbers. It's about really understanding yourself, your own psychology.
It's about having the right temperament, right? Like not getting swept up in every little market swing, not panicking when things get rough.
Exactly. Graham truly believed that being a successful investor. It's as much about psychology as it is about understanding finance and balance sheets and all that stuff.
Yeah.
Fear and greed, he knew those emotions. They can lead to really impulsive decisions that can derail even the smartest investment strategy.
So how do we cultivate that intelligent investor mindset? How do you stay calm and rational when everybody else is losing their minds? Did Graham have any advice for handling those moments of doubt?
He did. First things first, focus on the long term. Don't get caught up in those daily or even monthly ups and downs. Remember Mr. Market?
Oh yeah, our favorite character.
Right. Don't let his mood swings dictate what you do with your money. Second, do your homework. Really understand what you're investing in. Don't just follow hot tips or rumors. Remember, Graham believed knowledge is power, and when you're more informed, you can make more rational decisions. Decisions you feel good about.
Be an owner, not a gambler. I like that.
Exactly. And finally, he said, it's okay to make mistakes. Everyone does. The important thing is to learn from them.
It's all a learning
Yeah.
experience, right?
Yeah,
The
yeah.
market is always changing. You got to be able to adapt. So as we wrap up our deep dive into the intelligent investor, what's the one big takeaway you hope listeners walk away with? What's that one gem of wisdom from Benjamin Graham that they can apply to their own investments?
For me, it comes down to this. Investing, it's not about beating the market. It's about figuring out what you want to achieve with your money, what your goals are, and then finding investments that align with those goals. It's about thinking long-term, being disciplined, and not letting your emotions run the show. It's about becoming an intelligent investor, just like Graham talked about.
It's about tuning out all that noise, thinking for yourself, and making smart decisions that help you build a more secure financial future. Well said. And a huge thank you to you for taking us through the intelligent investor. This has been fantastic. And for our listeners, we hope this deep dive has given you a new perspective on investing and maybe even inspired you to learn more. Until next time, remember, knowledge is power, patience is key, and becoming a savvy investor, it's a journey, not a race.